Welcome back to the Deep Dive, where we like to, well, dive deep into a bunch of different investment topics. Today, we're tackling REITs.
REITs.
Yeah, like real estate, but without the headaches of actually owning property.
Yeah.
We've got a whole stack of sources here, everything from bank rate to bigger pockets, and we're going to break down what REITs are,
Yeah.
how they work, and of course the big question, are they a good fit for you?
The interesting thing about REITs is how they've kind of democratized real estate investing.
Right.
Like, historically, you'd need a ton of money to buy property, but REITs let you get started with, well, a much smaller investment.
So, okay, let's back up a sec. What exactly is a REIT? I mean, is it just another fancy Wall Street term for owning a building?
Not exactly. A REIT, or real estate investment trust, is basically a company that owns and oftentimes operates income-producing real estate.
Okay.
So think of them as like middlemen between you and a whole portfolio of properties.
So instead of me going out and buying like one apartment building, I could buy shares of a REIT that owns like 100 apartment buildings?
Exactly. That's the power of REITs. And it's not limited to just apartment buildings, right?
Right.
We're talking shopping malls, office buildings, data centers, cell towers, you name it.
Makes sense. But how do REITs actually, make money? And how do I, as an investor, get a piece of that pie?
Okay, so REITs, they mainly make their money through rent. They collect it from the properties they own,
Okay.
just like a landlord would, right?
Right.
Collecting those monthly payments from tenants, they can also make money from selling properties if they choose to.
So it's like getting a cut of the rental income without having to deal with all the landlord hassles.
You got it. And here's the thing. REITs are actually required by law to distribute at least 90% of their taxable income to shareholders
Okay.
in the form of dividends. So that consistent income stream is a big draw for a lot of investors.
Sounds pretty sweet. But I've heard there are different types of REITs, like equity REITs, mortgage REITs.
Right.
What's the difference?
So there are three main types. The most common one is equity REITs. They own and manage income-generating properties directly.
Okay.
It's like imagine owning a piece of a massive Amazon warehouse.
Yeah.
That's the power of equity REITs.
So equity REITs, those are like the landlords of the REIT world, right?
Yeah.
What about mortgage REITs?
Okay, so if equity REITs are the landlords, mortgage REITs are more like the lenders.
Okay.
They don't own the properties themselves. They provide financing for real estate, and they make their money from the interest on those loans.
Oh, interesting. So they're profiting from the financing side of the real estate market.
Exactly.
And then lastly, we have hybrid REITs.
Yeah.
Are those just like a combo of the two?
Exactly. Hybrid REITs combine elements of both equity and mortgage REITs. So they might own some properties outright and then provide financing for others. It's a way to diversify within the REIT itself.
It seems like there's a REIT out there for, well, pretty much every type of investor. But before I run off and start buying REITs, let's talk taxes. I know REITs are often considered tax efficient. How does that work?
One of the biggest tax benefits is that REITs avoid paying corporate-level income tax.
Okay.
As long as they distribute, at least 90% of that taxable income to shareholders as dividends. So that can result in higher dividend payouts for investors.
That's a pretty sweet deal compared to investing in a regular company. Their profits are taxed twice,
Yeah.
once at the corporate level, and again when they're distributed to shareholders as dividends.
Yeah, it's a big difference. And this tax efficiency is one of the main reasons why REITs are so attractive to investors who are looking for income.
But it's worth noting, though, right, that REIT dividends, they're taxed as ordinary income.
Right.
So your individual tax rate, which could actually be higher than the tax rate for, like, qualified dividends from regular stocks.
You got it. There are always nuances, right?
Yeah, some things to keep in mind. Okay, so we've covered what REITs are, the different types, and the tax advantages. But what are some things investors should be thinking about before diving into REITs?
Well, one of the first things to consider is interest rate sensitivity.
Okay.
REITs can be sensitive to changes in interest rates,
Yeah.
because those rates affect their borrowing costs, which then impacts their profitability.
So if interest rates go up, REIT returns could potentially take a hit.
It's a possibility, although it's not always a simple cause and effect. The real estate market is influenced by a lot of factors.
Yeah.
Economic growth, supply and demand, even government policies. It's complicated.
It sounds like I need to do my research. really understand the specific REIT I'm considering.
Yeah.
What else should I be looking at?
The performance of specific property sectors is crucial. A REIT's success is often tied to how well its underlying property sectors are doing.
Right.
For example, if businesses start downsizing and need less office space, office REITs could struggle during economic downturns.
So if I'm feeling optimistic about the future of e-commerce, maybe I'd want to consider investing in industrial REITs that own, like, warehouses and distribution centers.
Exactly. That's a great example of aligning your investments with your economic outlook. But of course, diversification is key. You don't want to put all your eggs in one basket, right?
Right. Diversification is always smart no matter what you're investing in. So speaking of the big picture, what about like overall REIT market trends? Are REITs generally a good investment?
Well, historically speaking, REITs have delivered pretty competitive returns over the long term. They often outperform both stocks and bonds.
Okay.
That's partly because of their unique structure and the steady income they generate. But it's important to remember past performance doesn't guarantee future results.
Yeah, of course. And with interest rates potentially on the rise, I mean, is there a chance REITs could underperform in the near future?
There's always uncertainty in the market, and REITs, they're not immune to economic cycles. Rising interest rates could put pressure on REIT valuations, especially those that have high debt levels. Okay. But some analysts believe that the real estate market's fundamentals are still strong, which could support REIT growth in the long term.
Okay, so there are both opportunities and risks to consider. Before we wrap up this part of our deep dive, can you give us a quick snapshot of the REIT market today? How many REITs are out there?
Right now, there are over 190 publicly traded REITs listed on U.S. exchanges.
Wow.
They cover a huge range of property sectors and investment strategies. And globally, at least 39 countries have established REIT frameworks, so it's truly international.
Wow, that's a lot of REITs to choose from. It definitely highlights the importance of doing your research before investing.
Absolutely. And remember, this is just the beginning of our deep dive into REITs.
Right.
In the next part, we'll dig into those risks associated with REITs in more detail, and we'll talk about how to evaluate specific REITs and make some informed investment decisions.
Sounds good. All right, so before we took a little break there, we talked about some of the things to think about before investing in REITs, like how interest rates can affect them and the whole thing about how different property sectors perform. But now I think it's time to get real about the potential downsides. What are some of the risks that come with REIT investing?
You're absolutely right. No investment is without risk. And with REITs, one of the big ones is fluctuating demand.
Right.
The performance of a REIT is often tied to, well, how much demand there is for the types of properties it owns.
So, like, if I invest in a REIT that mostly owns office buildings, and then suddenly everyone's working from home, that REIT could be in trouble.
Yeah, exactly. If companies don't need as much office space, those office buildings might sit empty, and that would definitely hurt the REIT's bottom line.
It makes sense. And we've seen this happen in real life with, like, the rise of online shopping, haven't we?
Absolutely. Think about traditional shopping malls.
Huh.
They've been struggling as more and more people shop online. Fewer shoppers mean lower occupancy rates, and that leads to declining property values for those malls. And that, of course, directly impacts the retail REITs that own those properties.
So some REITs are actually benefiting from this shift to e-commerce, right? Like those that own warehouses and distribution centers.
Exactly, you're getting it. As e-commerce grows, the demand for industrial properties like warehouses and distribution centers, it just explodes.
Mm.
Those types of properties are crucial for storing and shipping all those online orders.
Okay, so it's kind of a double-edged sword.
Yeah. Yeah.
Some REITs are winning, while others are, well, not doing so well. It really highlights why diversification is so important.
You got it. Diversification is key in any investment strategy. By spreading your investments across different types of REITs, you can reduce your risk. If one sector isn't performing well, others might be doing just fine.
So I shouldn't put all my money in, like, just office REITs or just retail REITs. I should mix things up a bit.
That's the idea. Think about investing in REITs that focus on residential properties, office, industrial, maybe even those specialized areas like healthcare or data centers.
And it's not just about diversifying across different types of properties,
Yeah.
right? There's also geographic diversification.
Right, exactly. Instead of limiting yourself to REITs that only own properties in your local area, consider branching out. Look for REITs with holdings in different parts of the country or even internationally.
That makes sense. So if one city or one state has a rough year economically, my entire portfolio won't be affected.
You got it.
Okay, so we've talked about market trends, diversification, but what about the more practical things, like how are REITs taxed? I know they're often talked about as being tax efficient, but are there any catches?
There are some things to be aware of when it comes to REIT taxes. While REITs do avoid corporate level taxes by distributing most of their income to shareholders, those dividends are taxed as ordinary income.
Okay, so even though the REIT itself doesn't pay taxes on that income, I, as the investor, still have to pay taxes on those dividends.
That's right. And your individual tax rate might be higher than the tax rate for what are called qualified dividends from regular stocks. So that's something to factor in.
So it's not always a simple tax situation with REITs.
Yeah,
I need to really think about how those taxes will affect my overall return.
you got it. And remember, REIT dividends are typically not eligible for the lower tax rates on long-term capital gains.
So it's not as straightforward as it might seem at first glance.
No, there are definitely some things to keep in mind.
Okay, well, good to know. Now let's talk about something else that's super important,
Hmm.
the management team. I mean, when we invest in a REIT, we're essentially putting our trust in the people running it,
Yeah,
right?
you're absolutely right. Just like with any company, the quality of the management team is really important.
Okay.
In the case of REITs, they make a lot of the big decisions. Buying new properties, managing those properties, how they finance everything.
Yeah, makes sense. So how can we as investors figure out if a REIT's management team is, you know, good at what they do? Are there any like signs we should be looking for?
Well, the first thing is experience and a solid track record. Have they successfully managed other REITs in the past? Have they made smart decisions?
So doing some background checks, looking at their resumes, that's a good starting point.
Exactly. And also, look for transparency. Do they communicate clearly? Are they upfront about their strategy, their performance, both the good and the bad?
So it's about trust, really, isn't it? I want to feel like the management team is being honest with me, that they're looking out for the best interests of shareholders and not just themselves.
Exactly. And that brings up another point. Sometimes you have to watch out for potential conflicts of interest.
Okay, what do you mean by that?
Well, a REIT's management team might be incentivized in a way that's not in the best interest of shareholders.
Yeah.
For example, their compensation might be structured so they get big bonuses for short-term gains, even if those gains aren't sustainable in the long run.
Oh, that's tricky.
It can be.
So we need to dig a little deeper, look into how the management team is compensated, and see if their goals are aligned with ours as shareholders. It sounds like due diligence is really important.
It absolutely is. Investing in REITs isn't just about picking a property type and hoping for the best.
Yeah, it's more complicated than that.
You need to understand the risks, evaluate the management team, and make smart decisions based on solid research. It's like being a detective, putting all the pieces together.
Okay, that's a good analogy. So we've covered a lot about REITs, both the good and potentially not so good. In our next segment, maybe we can dive into some practical tips for researching specific REITs.
That's a great idea. We'll give you some tools to help you make those informed decisions.
All right, welcome back to the deep dive. We spent this episode really getting into REITs, exploring everything from the basics to the risks, and even how important the management team is.
We've gone through a lot, but it's all about helping you understand these investment vehicles, how they work, and how you can potentially benefit from them.
Exactly. So now, the big question. Where do REITs actually fit into your overall investment strategy? I mean, are they a good fit for every investor?
Well, that's the key, isn't it? There's no one-size-fits-all answer when it comes to investing. REITs can be a really valuable addition to a diversified portfolio,
Okay.
especially for people who want to get into real estate but don't want the hassle of actually owning and managing property.
So it's not like they're replacing traditional stocks and bonds, right?
Right.
It's more like they're another tool that investors can use.
Exactly. And like any tool, you got to use it for the right job. For someone looking for consistent income, REITs with their dividends might be a good fit. Someone else who's more focused on long-term growth, they might be looking at REITs with more potential for appreciation.
Makes sense. So let's say I'm thinking about adding REITs to my portfolio. Where do I even start? I mean, there are hundreds of REITs out there.
It can definitely feel overwhelming, but you can narrow it down. First, I'd say take a good look at the REIT's investment strategy. Like, what kind of properties do they actually own? Are they focused on residential, commercial, industrial, something more niche like healthcare or data centers?
So if I'm really optimistic about, say, the healthcare industry, I might look at REITs that specialize in, like, medical office buildings or senior living facilities.
Exactly. Aligning your REIT investments with your overall economic outlook, that's a smart move. But you gotta go beyond that too. Look at the REIT's track record.
Yeah, that makes sense. Look at how they've performed in the past.
Right.
See how well they've handled different market conditions. It's not a guarantee, but it gives you some clues.
Absolutely. Check out their financial reports, look at their history of dividend payouts, pay attention to how they talk about their strategy and what they think the future holds. Transparency and good communication, those are really important signs.
Yeah, it's kind of like checking someone's references before you hire them, right? You want to make sure they've got a good track record and that there's someone you can trust.
That's a great way to put it. And of course, we can't forget about diversification. You don't want to put all your eggs in one basket.
Right, back to diversification again.
Exactly. So spread those investments out. Invest in REITs that focus on different types of properties.
So residential, office, industrial, and then maybe those more specialized areas like data centers or self-storage.
You got it. And don't forget about geographic diversification, too. Look at REITs that have properties in different parts of the country or even internationally.
It's all about spreading that risk around.
Exactly.
It's exciting to see how REITs open up a whole world of possibilities for investors. It's not just about buying a building, it's about thinking strategically.
Absolutely. It's about taking control of your financial future and using different investment tools to help you reach your goals.
But we have to be realistic.
Right.
There are risks, right, even if you do your research and diversify.
You're absolutely right. No investment is risk-free. And that's where a financial advisor can be really helpful.
Yeah, having someone to guide you through the process can be super valuable.
They can help you create a plan that fits your specific needs, your goals, your risk tolerance.
Okay, so to sum it all up, REITs can be a great way to build wealth, but you have to be smart about it. You got to understand the risks involved and do your research.
Absolutely. Understand the different types of REITs, do your homework before investing, and think about your own risk tolerance and goals.
And if anyone out there wants to learn more about investing, be sure to subscribe to our YouTube channel.
Yeah. We've got a lot more deep dives, financial insights, and investing tips coming your way.
And let us know what stocks you'd like us to cover in future episodes. We love hearing from our viewers.
Until next time, happy investing.